Right, so let's get stuck into it then. I'm here to talk about FX, um, the poor men of the trading world, as it's sometimes known, the Wild West, as often people call it. So what I'm mainly going to do, I haven't got a product per se to sell, but we have got the FX room opened up under the TopStep banner now, so feel free to drop in there. I think most people have got access to it. Let's get some screens up here. Right, there we go. Everyone should see my screens there. Let's go on. Right, as Porcupine points out, we've got the crude inventories in 5 minutes, so maybe we'll do a little bit of live viewing of that when that comes up. I've got my charts up here. I'll get them set up. So yes, we've got the new live Forex trading room opened up, which you'll see there, and me and a couple of my crew from forexflow.live are going to be in there, keeping an eye on things and posting our trade ideas and talking about markets. And that's pretty much what I want to do today is just go over the current sentiments and the current moves that we're seeing in markets and some of the reasons behind them, and what we expect for currencies sort of now and through this year. I'll stick to the pretty main currencies. One of the favourites being dollar yen. It's a currency that a lot of people look at, whether you're trading FX or not. Everyone has half an eye on that currency. It's the proxy for the US dollar, and it's linked so much with everything else that goes in, with bonds, with stocks. The melting pot that goes into trading. Now, pretty much this year, I've been bearish on this pair for pretty much since the US started hiking. And when we look at the charts, it's pretty clear that every time we've seen a hike, every time we've seen something hawkish, the dollar's been sold off after. Now you get a lot of the buy the fact, sell, or buy the rumor, sell the fact. But all through this stage, from 2014, the taper, the first hikes, 2015, 2016, after every single time we've had a sell-off in the dollar, and particularly this pair. And so when you've got a market that's always saying buy the dollar, buy the dollar, buy the dollar, and the price isn't conforming to that, then as a trader, you've got to look at it and think, right, well, what's going on in the market? And this is a case pretty much that we're seeing at the moment. The dollar's broken down in the last week or so. We've had a range for 2017, and it's broken. So as we can see on the charts, we were up at the high 125s, towards 126 up here. We got hikes, as I say, we got the end of the taper. We've got hikes in 2016. We got pretty much confirmation, but either through the taper and normalization, again, we saw this big move down here. Then we consolidated. That's when we really started running into the hike cycle. Okay, everyone all right here, guys? Yeah. So this was into the December 16 hike, which was pretty much the beginning of the proper Fed cycle. And also don't forget, we had the Trump presidency taking over. That helped give the dollar a big boost. But again, we hit up here, and the Fed's hiking away, and all we've done is fall down. Now again, what we look at when I trade is I look at ranges, and 2017 had a big range. I'll zoom into the chart here. So pretty much this 1450, 1460 area up here, very strong tops throughout last year. And down below, not as clean, but around this 108 area, we had some very strong bottoms. And that was pretty much your benchmark for the whole of last year. You could pick your bottoms around the 108s, and you could sell into the 104s and sit back and be happy with it. And so what we've seen now is your typical break of the range, which is down here. And that's been confirmed over the last few days. We had this low down to the 105.50 area, and we've had a bounce, and we couldn't get back into this 108 area. We had several attempts at doing so, and we just couldn't get back in. And as sure as eggs is eggs, that's a catalyst for another move down. And so therefore we've seen it. So we can see these tops here. Lots of screen changes. So we've got one of the little tops there. And then we've got these other two tests, got up to sort of the 107, 80, 90 area. We've had the failure, and back down again we've come. So in my mind, the dollar is still, or this pair is still a very bearish pair. It's a rally seller. You pick your levels and you sell into the decent rallies. And this 108, 108.50 area is a big area. Can't get above there, then we're going to carry on heading lower. But what we've got facing the other side of this pair this year is the Bank of Japan. They're really the last central bank to be balls deep in QQE. They're still throwing the kitchen sink at this thing. One of my guys, K-Man, who's listening today, he's our regular Japanese expert. He's an ex-interbank trader. Spent loads of time out in Japan, so he knows the moves out there inside out. And the Bank of Japan, because it really is the last game in town, there's mounting pressure on them to dial down on their policy. This huge QE they're doing, this yield curve control, and so from a fundamental point of view, this is a big trade to look at for the yen side of this pair, because we've already started to see the market getting involved and looking at the Bank of Japan and starting to try and guess when they're going to start making a move. And this is potentially going to be another very, very big move if they start doing it. I mean, if you look at the euro, since the best part of a year and a few months, it's done nothing but rise. That was on the basis of the ECB potentially ending QE and inflation rising. All the ducks lined up, and we've seen this huge move in the euro. It was down at 103.50 odd, a year or so ago, and now we're up at 123, been up to 125 odd, and a huge move. And that's the market getting behind expectations for the ECB cutting QE. We saw the same in the dollar. We saw the same in dollar yen with the Fed when they were going to hike with a taper. So what I tend to look for, I look for these big trends. I look for these big moves and try and anticipate where they're going to kick off and where they're going to start. I was fortunate enough to grab pretty much the bottom in the euro move. The guys on my website will know all about that. I'm still long small euro dollar that I've been holding for over a year. And what I like to look at is getting in those big long trends, those big long moves. So in regards to dollar yen, it's already had a big trend. We've been down from this 114 area, and pretty much it's come all the way down here, pretty much near on 1,000 pips. That's a big move in itself. But we're not even scraping the barrel yet when it comes to the Bank of Japan. Because if they start talking about tightening, we could be sub 100 even more. The only flip side to that is that they won't want the currency dropping that far. So they're potentially likely to put procedures in place so that they don't see that happen. But that's something that's yet to come out in the wash. We don't know anything about that yet. We don't know how they're going to look to exit. But at some point they do. When Ben Bernanke said that QE was unlimited, that was all well and good at the time. But then even the US got scared that perhaps they were going to have to go unlimited. And no central bank wants to do that. And the Bank of Japan are still full on, and this is a big unwind that's going to be coming. Let's just have a quick look at a couple of questions. How long will they tolerate stronger yen? This is the thing with Japan. If you're talking just pure intervention, they don't intervene. They don't even think about intervening unless markets are very, very volatile. And what we saw over last week or so, that's not even close to their ballpark. There's normal market moves, there's normal volatile market moves, but then there's excessive volatile moves. If we start seeing dollar yen dropping 500 pip clips over the course of 3-4 days or a week, and it's completely crazy, that's the sort of landscape that the Bank of Japan, or rather the Ministry of Finance, will step in and get the Bank of Japan to start intervening. So they're between a rock and a hard place, much like every other central bank is. One of the things Draghi mentioned when he first went into QE was the strength of the euro and how it took off X amount of percentage points off of inflation. Well, now inflation's going back up. Now the economy is improving, and naturally the euro's rising. So the same issue applies there. How do you deal with a strengthening currency? You've got to take the rough with the smooth. If you've got an economy improving, you're going to have a currency that's improving. So it's all a big offset. So with regards to Japan, yes, they will be looking at the currency and they will be very worried about what their unwind might do. They're probably half hoping that the dollar does strengthen on the back of the US economy, because that will do half the work for them. But as I pointed out earlier, you've got a economy doing well in the States. The jobs market is great. Inflation is up around target. It's all coming up roses, and yet all we're doing is see the dollar get sold off, and in particular, dollar yen get sold off, and so that does cause some concerns for the Bank of Japan. But this is something that's going to be borne out over this year, we believe, at Forex Flow. So it's a really big trade. How we can get into that trade and trade it, well, once again, we stick to the charts and we look at the levels. We've highlighted that this 108, 108.50 level is a strong resistance point. Now, if you want to take a longer term view, then those are the sort of areas you want to start scaling into shorts, up further up against the 110 level, the 110, 111 area. Again, a strong point of resistance in this old range, and is likely to be a strong point of support in the old range. Is likely to be resistance on the way back up. So I tend to do longer term trades. That's my forte. I like to get in these nice trends early if I can, scaling small positions against the support or resistance levels, and ride out what happens. I have my assessment points, and places where if it crosses against me, I start to think, well, perhaps I'm wrong, and what am I going to do? Am I going to cut down my positions or not? So in terms of dollar yen, I was actually interested in selling up towards this 108 level, but my usual methods of being a dick for a tick. We got up to sort of the 89s, and I wanted to get in at 90s, 95s, so I didn't get a trade. But again, I want to be looking at these 108, 108.50 levels. That's my near-term place where I would short this pair. But then let's look at the flip side. Look at the downside. I marked up a big area here at 105, and just today we've had news that the big Japanese life insurance companies are coming in and they're loading up on foreign bonds, including US Treasuries, and they're happy to start hoovering up dollar yen down at the 105 area or below. Now, for those that don't know, these guys in Japan, the life insurances and the pension funds, they are huge. These are huge companies. They are market-moving companies. When they all decide to pull in one direction and buy bonds or sell a currency or whatever they do, it is market-moving, and it has ramifications across what you see in bonds, what you see in stocks. There is trillions and trillions of yen and dollars that are involved here. So we've heard today that two firms in particular, two life insurance companies, Nippon Life and Meiji, I think they're called, they're happy to carry on buying foreign bonds and particularly US Treasuries. They increased their holdings into January to a record high last seen in August 2016. And the CIO of Nippon today said that he was happy to buy dollar yen below 105. Recently, we've seen a lot of action in the options down at this level. We've got some binary barriers, as they're called, which are option strategies down at the 105 or 104 level. I won't go into the ins and outs on that right now. But again, this is potentially all adding to the support area down at the 105 area. And as traders, we want to know as much about what's going on in the market as we can. So what we're finding out is that we've got big sellers at 108, and we've potentially got some huge support coming in at the 105 area. So we're only small fry. We're not going to compete with these guys. But if we know we're on the bid, then that's pretty good signal to get in front of them and trade off their back, if you like. So at the moment, I'm looking at this 105 area. I'm looking to scale in longs potentially from that low, that recent low at 105.50, just in there. I'm looking to scale in longs around that area down to 105, probably with a stop just below. There is another area of support, 104, but I'm not seeing it as strong as this 105 area at the moment. So I'm less inclined to do a wider trade down to that 104 area, but it depends how that picture develops. So I may be bearish on this pair, but market's always two ways, and nothing goes in a straight line. So while I'm a happy seller around the 108 area, I'm a happy buyer down at the 105 area. And we wait to see how it does in the bigger picture. And as I mentioned, we keep our eyes on the Bank of Japan and see what they do and see what noises come from there, and we potentially get on board with them, or we jump out the way. And that's pretty much the same for most of the dollar pairs. If we switch to the pound, I'm from the UK. I trade the pound a lot, but I've pretty much left it alone throughout this Brexit mess, because it is a big mess. People on the outside probably see it as a mess. Well, there's plenty of us on the inside who see it as a mess too. But we've seen a very, very strong rally in the pound. Let's see if I can get a chart up here. Which one? Let's try again. You have to excuse me. I've got so many charts on my screen, I never know which one to use. Right, that one will do. So again, this year, Steve, do I support Brexit? Yeah, I voted for Brexit. I voted for Brexit because I don't believe the European project is what it originally set out to be. I think it's a good idea that's being poorly executed. I didn't believe all the claptrap lies that were fed out about, on the campaign buses about, we're going to 350 million can go each week back into the NHS. All that crap I didn't believe. I just didn't believe in the European project. But that's politics, and I'll refrain from getting into that side of things now. But I voted for Brexit, and it's done, and we'll live or die by the decisions. I don't think it'll be as bad as everyone makes out. And at the moment, neither does the market. As we can see here, even this year, we had a good area in December where we got through phase one, and again, the pound has done nothing but rally. We've seen some softness now. I wrote on the site a few weeks ago that we're going to be entering another period of uncertainty where we've got a potential deadline in March coming up because there's an EU summit, and the guys there, Barnier and his mates, they want some idea on the transition period, and they want some idea of the basis of any trade deals going forward. And what we're going to get is the usual UK saying, yeah, we're going to do this, that, and the other, and the Europeans are going to turn around and go, well, no, you're not. In market terms, that's uncertainty, that's negativity, and that means the pound is going to be soft, and it's going to be offered, and it's likely to fall more than it's likely to go up. And thus we've seen these highs up at the 142, 143 area. The Brexit shenanigans are kicking in again, and now we're just starting to see the move slide down again, and the pound come off. And that's probably going to run into this March summit. And again, that might be a time where you want to buy the quid, because the likelihood of getting a deal done or getting an agreement done at that period will probably come down to the last minute, for all the political jostling. the UK will want to get something done and they will cobble something together. We saw exactly the same in December. It was left to the last minute, even over the last minute, but they got something now down. Beginning of December, that was a time when I prompted buying the pound, and I wrote on site that this is the time to buy the pound into December because we'll get a deal done. A deal got done, the pound rose, I got out, happy days, money made. So I see a similar position coming here in this March summit. But I'll be looking at the news and seeing how it lies. But keep an eye on the site, and we'll keep you updated how that goes. So the other currency to look at, as I say, I wanted to stick to pretty much the major ones, is the good old euro dollar. Again, from the latter part of 2016, it's been nothing but up. Very, very strong trend. Very, very strong trend there. As I say, I was fortunate enough to start buying it. I was buying it from the 106 area. I think December, so round about this area, I started buying it, and I managed to buy it all the way down to pretty much the lows. And I've ridden it all the way up here. I've exited it out. I'm probably left with a small chunk of that position now because I got out on the way up. And you know, it's this second leg here that we saw late into the year or the beginning of this year. That's pretty been surprising for me because I thought this is round about the top. This is where all the expectation of the ECB tapering and cutting down what they're doing. I pretty much thought that was going to be a temporary top there, or a pretty solid top actually. And I was expecting a bit more sideways action, but we got the kick early part of the year with again this dollar sell-off, and that's taken us up to another leg. As we know, the ECB are supposedly coming to the end of QE. September is the deadline. The market is now sitting around waiting to see what clues the ECB are going to give about how exactly they're going to finish QE. Are they going to stop it dead? Are they going to taper some more? And then they're going to get onto the bone of when they're going to start raising rates. A lot of the market is looking at probably the first quarter of 2019. And, you know, a lot of what drives FX markets is expectations, and especially expectations of central banks. I rode that expectation. That was purely the basis for that trade, the expectation that the ECB would come to the end of QE. So there's still some room left in this trade, but you've got to pick your levels. In this case, you know, looking at this strong double top here around that 120, 121 area. Let's just zoom in. So that's a pretty strong double top up there, and that's the sort of area where I'd look to add back into longs, and to take the next leg up and to run it into what the ECB are going to do next. They're going to end QE just like the US did. They've got to do it. They can't keep running it, and they're going to start raising rates as long as the economy performs. So, in one aspect, it's a certainty, but of course, there's always two sides to a currency, and we've got to watch what goes on in the dollar. So, I mean, I am expecting the euro to remain at these higher levels. I'm still not expecting it to rally as much as we saw last year, which is why I'm you know, less inclined to just jump in blind and hope that it rallies. I'll pick my levels. And say that 121 area looks a very good area to build longs. But I'll also be mindful if we break that area and carry on falling. You know, if we're wrong, the best advice is to get out. So that shifts everything for the ECB into September. But again, there's a lot of focus coming in on the March ECB meeting, because that's where the market is expecting to get the next clues about how they're going to unwind all this. And we've pretty much got a blueprint from the Fed. You know, the Fed did QE, the Fed exited QE, the Fed laid out their plans for rolling off QE, and then the Fed started raising rates. And markets are you know, they copy. It's the same scenario over and over. So I'm expecting exactly the same sort of moves in the euros as we saw in the dollar. And once we get to that expectation point where the market is in balance and they know what's coming, that's when you think about selling it. That's when you think about getting out longs. That's when you think about trying to look for tops. Because again, like the dollar, I think we're going to have exactly the same thing with the euro. Once the market knows exactly what the ECB is going to do with rates, when they're coming, that's potentially going to be a big, big top in the euro. And you know what, folks, that's normalization for you. We've just come off, 5, 6, 7 years of extraordinary monetary policy, and normality is now not moving 500 pips on every rate move. It's not moving 500 pips on every point in inflation. I can remember the times when dollar yen used to move 10 pips in a week. So normalization is going to be a bad thing for Forex markets in one aspect, because the volatility is just going to drain off. We have been hitting extreme volatility over the crisis. Last year was actually very, very bad for volatility, and that's also been a surprise that it's picked up so much this year. But volatility is what us traders live on. So if markets are flip-flopping around, then we've got opportunities, and that's what we need to look at. So to pretty much summarize just the sentiment in the market now, there's still people out there very bullish the dollar. We're seeing this big asset switch out of bonds into other assets looking for higher yields. Part of the reason for that is inflation rising. So even though bond yields are rising, those returns are still being eroded by the inflation rate. The Fed's on a hiking path. Again, it should be beneficial for the dollar, but it's not. The ECB, they're going to hopefully come to the end of QE and enter their rate hike cycle. And over in the UK, we've still got the Brexit mess, which is going to be going on and on all through this year, and that's going to bring big highs and big lows and big swings. So those are pretty much the fundamentals of trading FX this year. What we hope to do in the room is I've got some traders who trade all sorts from long term to short term. They're in 1 minute, out the next minute, and we're going to be bringing some of that into the room. So, feel free to stop by if you want to have a look and a chat about what's going on in the FX markets. And no doubt a couple of us will probably hop skip into some of the other rooms to find out what you guys are doing. And that's going to be, I believe, we're going to be going full bore on that from tomorrow. So we look forward to seeing you in there. And if you've got any other questions, because I do like talking, as you may have found out, fire them away and stick them in the comments now, please. Okay, no questions for anyone. If that's the case, I shall hand the baton back to the guys. Oh, hang on, here we go. Hedgehog's up. What about further problems with the Italian banks? That's an interesting point. The funny thing with Italian banks is they're offloading their own debt as quick as they can manage it, which is always rings the alarm bells when your own banks are dumping your own debt. Of course, we've got the Italian elections coming up. They're also in March, early March. So again, that's another risk factor for the euro. I don't think the euro is actually pricing in any risk to that right now. That's probably going to start ramping up. But right this minute, I don't think we're seeing any risk being priced in for that. What I tend to look for judging risk parameters is the 1 month at the money option volatility in the currencies. Over the French elections last year, we saw volatility rise in those options in the euro yen. And a big reason for that was because the Japanese had a big holding of French government bonds. They held something like 13% of votes. And so they started pricing in or hedging against that risk, and we saw volatility rise. As I say, I don't think we've seen much in the way of that pricing coming in yet for the Italian elections, but that's something that's probably going to start picking up anytime soon. So that's something we'll keep an eye on. That's something we report on on the website. So keep an eye on that. No problem, sir. Okay, Marlon, do you want to take it back over if there's no other questions?
Good job, Brian. So excited to have you here.
Cheers. Thanks a lot, guys.